have a little game for us. I'm going to ask you a couple of situations where you may put your money somewhere, and I want you to tell me if you would invest your money or if you would save your money. Okay?
I like it. Let's go. Welcome back to our channel, Richard's Family Legacy. Today, we're going to document our journey on how we're building our family legacy. I'm Jermaine Richards.
And I'm Camille Richards. We are two siblings working together to establish our goals, and we're bringing it to you here every Sunday.
And today, we're going to be discussing what, Camille?
Today, we are discussing the differences between saving and investing.
Okay, so let's start off our topic like this. What are those? Because these are two terms that get thrown around interchangeably sometimes, and they're really not, are they?
No, they're very different.
Very, very different. So you have savings on one hand, and then you have investing on the other hand. Before we look at the differences, I define savings as money that you put away for a need, right? You have a certain need, so you put that money away, and you have that intention that you're going to use it later. So essentially, you want the money to be there when you need it, right? How would you define investing?
So investing is a way to put your money into a vehicle, and then you want to see that money multiply by a certain percentage, usually over time, right? So you're going to put in $10 and you want to see some kind of a benefit at the end. So you may want to see $12 or $15, or hell, you want to see $100, really? Let's be real, right? So you want to see that multiply in one way or the other.
Right, right. So if we want to break it down, investing, you want your money to grow. Savings, you want your money to be there when you want to use it.
Exactly, because investing does come with a certain set of risks. You can always lose that initial $10.
So it means then if you're going to invest, and we'll touch on this in a little bit later, you're going to take on some sort of risk, right? Whereas when you're saving, you're not really taking on your minimal risk, if any, you're going to take on when it comes to savings, right?
Yeah, exactly. So Jermaine, I have a little game for us. I'm going to ask you a couple of situations where you may put your money somewhere, and I want you to tell me if you would invest your money or if you would save your money. Okay?
I like it. Let's go.
All right. So let's start with an emergency fund. So that money for rainy days or for an accident, are you going to invest that money or are you going to save that money?
I would save that money. I would put that under the savings category.
And I predetermined my answers, and I agree. I would put that under my savings.
Okay. So
So what about retirement? Would you save for your retirement or would you invest for your retirement?
I think depending on the age. So if someone hasn't started saving for their retirement and they're young, they should invest because they have time to take risk. If someone is, let's say they're 60, 60 years old and they have 5 years to retire, they should save. They shouldn't invest because they don't have the time to take the risk.
So I would disagree a little bit. I agree that the risk should be different in younger and in older people, but I still think they should always invest. I think there are vehicles that carry less risk that people that are of an older age can put their money in, still see some growth, but saving itself may not be enough, especially at 60. Okay, so I am a
Well,
travel.
think about it. At 60, they've already messed up. It's already gone bad, right?
But there's still vehicles that they can use to invest in, that may not lose their money, but they can still prevent or still produce an income or a value to it. So remember, we're saying saving is putting your money with little to no growth, right? You still want to have some growth because that 60-year-old, especially now by today's metrics, may still live to 100.
Agreed. Agreed. But they start using their money at 65 usually, right? So that's a 5 year time frame that they have. So it's a little bit tricky. That's why I said both. But yeah, agreed to disagree.
Fine. Uh, travel fund. Are you going to save
Saving,
for your
saving.
travel
I'm gonna
fund?
save. Yeah,
Yes.
that I'll save.
Yes, same. I am going to save my travel fund because 100% I'm going on that trip. We don't got time to.
You're not risking anything.
We don't got time to risk it. Okay, so we are both embarking on a business venture here. So when we finally become profitable, are we saving or are we investing that profits
It depends for what though.
in general? What was your first off of the tongue?
You're talking, okay, let's clarify. So we're talking for the down payment of the investment property, or are
No,
we
I'm saying
talking
no.
once we're
You
the
didn't
whole
hear me.
business is
Once
profitable?
we are profitable, yes. Once our business is profitable, right? We're 15 years down the road. We're finally seeing hopefully it doesn't take 15 years, but you know, we're finally seeing profits,
Yeah,
right?
yeah. For me, it would be a mixture of both.
Mixture of both.
Yeah.
I would say investing. Okay.
And you're gonna learn why she says that soon.
Yeah.
Our perspectives are um,
Very
vastly
different.
different.
Very, very different. Okay. Tuition money. You're saving
Tuition
for
money.
Dylan and Olivia.
Um, Again, time horizon.
Okay,
Uh,
right now.
right
No
now,
time.
yeah,
Right now.
because of their time horizon, I'm talking. Um, Investing.
Okay, I agree. I think you should invest that money. Now here is where we're actually going to differ. Down payment for a house.
Down payment on a house. Okay, time horizon comes in. If you're purchasing the house, I will say in the next 5 to 15 years, probably you wanna balance your approach. Mostly though, savings. Mostly savings. Um, if you have a longer horizon, then I would go mostly investing. But I think it should be balanced. It should have a mixture of both.
See, you don't like to be concrete. I'm concrete. I said invest, invest that money. But again, this is my perspective because I don't even know if I want to own a house.
Yeah, exactly.
So I'm
Exactly.
investing that money. I do have savings, and we'll talk about that. But I for a down payment, mostly it's going to be money that I invest.
Hmm.
All right. So we kind of see where we both are sitting in the invest versus savings arena, right? I think we're very similar, but in certain minute differences, we would do something different with our money.
Yeah, and I think that's the beauty of understanding both, because then you can determine what approach is the best for you, right? And your situation. So let's jump into then the differences between um investing and savings. When should someone invest? When should someone save? We kind of touched on that, but what are like the differences? Like if we were to put two columns up, right? And one says investing and one says savings, and we look at a term like risk. How does risk fall into investing and how does risk fall into savings? Like what are the differences between the two?
So yeah, I think if you go back to the definition of savings versus investing, it's kind of right in there. So, saving is you want to see that money at the end of the day. You want to see that $10. So, you want the least risk possible, right? So, savings equals low risk versus investing. If you want to make money, you got to be willing to lose money, right? So, the higher risk, the higher the reward. So if you want to invest, you're going to take on some level of risk that can be adjusted based on what you're investing in, but there's always going to be a chance of losing that money.
Yeah. Like if you've ever gone to a financial advisor or even the bank, and you're going to open up something like here in Canada, mutual funds, for example, you're going to open up a mutual fund account, right? They always have this risk reward question on the questionnaire to open up the account, right? So, for example, if you would you invest $500 with the opportunity to gain 1,000, and then that number shrinks, right? So 100 to gain, you know, to gain 50. And what they're trying to determine is what is your risk to reward ratio. So essentially what you're saying, and I agree with you, I concur, is if you are saving, that risk to reward ratio is very, very small, right? Whereas if you're going to invest, you're looking to multiply, you're looking to grow, you're looking to gain a lot more than what you put in initially. So I agree. I think savings, not too much risk. Investing, let's risk it all. And that's more your game. You know, Camille's a young single lady. She has, that appetite
I like
for
a
the
lot of
risk.
risk.
She likes the risk, you see?
What's
She likes,
yours?
she likes the risk.
What
My
about you,
miss
Jermaine?
my risk is moderate, right?
Moderate.
I mean, um when I was young and no kids, single for sure, I liked risk too. Um, but and I think as you grow older, that risk starts to shrink, right? You start to tighten up that risk. Hence to what I was talking about with the retired person when they're older. The risk starts to get, you tend to want to hold on to more rather than throwing it all out there. But there should be some level. This is where I differ from a lot of people. There should be some level of risk for investing. You agree?
I obviously there's always going to be some risk when it comes to investing.
Yeah.
So we talk about risk. Now let's talk about return. When you put your money into a savings account, what kind of return do you expect to see?
In a savings account, it's funny you ask that. I'm not going to name the bank, but in the summer, I went and they offered a high interest account, and it was 0.1%. You had to have over a $500,000 to get this high yield interest account. It was 0.1. I can pull it up. I have a screenshot of of the little pamphlet they gave. So here in Canada, really invest savings accounts, or they're embarrassing, right? I saw one where they were giving 3 or 4%, but it was only for 6 months. You sign up for this
What?
account, they give it to you for like 6 months. So when it comes to savings and expectations from an earnings perspective, you're lucky to be getting 1% or anything near that for a long period of time. All right.
Disclaimer, in Canada,
Yeah, this is
unfortunately.
Canada. This is Ontario, Canada, to
That's
be quite
unfortunate.
specific. Yeah,
Oh
it's
my gosh.
bad, right? So if you're gonna save your money here in Canada, you're not saving it with the intention of getting anything back. There's no return when it comes to savings. So give me your perspective from the US.
So so baseline, I think you're absolutely right. You shouldn't have any expectation when you're saving money to necessarily get anything back. That interest rate can change very quickly. In the US, I think maybe because there's maybe a little bit more competition, the interest rates in saving accounts are actually fairly good. So as I was saying, my emergency fund, I've actually just kind of decreased how much, like greatly decreased how much of my um income that I actually put in there, because one, I got to where I wanted to go with it for at least this period of time. And then two, I stopped at a point where every month I'll actually get $100 on my capital, right?
Mhm.
So, and that percentage is like 4.4, 4.5. It's like, or something even higher, maybe close to 5%. All right. And that's a high yield savings account. I won't say the name, but that at least helps me, continue to grow a little bit. But ultimately, that can change at any time. They're under no contractual, um, what's the word? They're not
Obligation.
obligated. Yeah, they're under no contractual obligation to give me that percentage, right? Now there are saving vehicles that offer that, right, where they'll give you a certain percentage for keeping your money for a certain amount of time. But for a regular savings account, no. But it's nice here that I do get a decent, quote unquote, decent return.
Yeah. So going back then to your question, I think returns you can expect when it comes to investing, right? And people have different perspectives of what returns they should expect. And it depends on the vehicle, right? It depends on the vehicle. But I think definitely it should be above inflation when you're starting to look at investing. Investing, you got to at least beat inflation, or in my opinion, you're not really investing, right? And here in Canada, inflation's very high. It just came down a bit, but
What is
you know,
inflation there?
it's over 3%, 4%, something like
Mhm.
that. I
Mhm.
don't know the exact number, 3, 4%, somewhere in the range. Canada likes to keep it under 3%, but it's still above.
Yeah.
Uh, you know,
So, yeah, so basically for savings, you expect little to no return, right? And for investing, you want to try to return is not guaranteed. So first of all, right, in
yeah,
investing,
yeah,
either, right? But you want to try to get a return that is at least greater than inflation, is the general goal. But the goal is to get a return, to get money made on top of it. So now let's talk about liquidity. So what's liquidity, Jermaine?
liquidity in simple language. And by the way, I just want to do a quick disclaimer. I looked it up. It's actually 2.8% of inflation
See
Canada.
how you do Jamaica, Canada so bad.
I know I was giving them
What?
a hard time. I
Listen,
just have to put the disc
Give Trudeau his flowers, please. Please.
never. um, so liquidity, my definition of liquidity is how easily the money is accessible to you, right? The more liquid the money is, the easier it is. Like the most liquid your money can be is cash, right? And then if you want to talk about the least liquid would be like a hard asset, like real estate, for example. You got to liquidate it first before you can obviously use the cash. Um, and then there's a whole bunch of things in between, right? So the more liquid your money is, the easier you can get it. Less liquid it is, the harder it is to get it.
And so when you save your money, you would say that that is more
Liquid,
liquid.
liquid. Yeah, I would say if you're gonna save, yeah, you're looking to be on that side of the scale, liquidity, and then investing. You can go as far as you can or want or is willing to risk in
Mhm.
terms of hard assets, they call them.
Yeah. So like for example, if you have your money and you buy an investment property, so
Hmm.
exactly kind of what we're doing, you're not you can't expect to get that money tomorrow, right?
Exactly.
You will have to sell it, then it'll have to go through all of the fees, etc., and then you'll eventually get your money, your return, right? That may take months.
Yep.
Versus if you have $500 under your mattress, you can go get it right now if you want.
That's as liquid as they come.
Right. So savings, quick availability. Investing, not so quick.
And one of the other things too is time.
Yeah.
Time is a huge factor when it comes to these two columns of savings and investing. So, what's your perspective on the time horizons for savings and the time horizons, let's say, for investing?
So this kind of goes back to what you were saying regarding like the retirement, right? So when you're putting money, or let's say this, when you're trying to decide where to put money, and you have a specific use for that money, then you want to look at how long until that use is going to become relevant.
Hmm.
So let's take me and my housing, if will she not dilemma, right?
Hmm.
Who knows when and if I will ever buy a house, right? That's the millennial thing, right? I was just listening to another podcast the other day, and they're saying millennials just they aren't buying houses for several reasons. And I am kind of just like every time I think about it, I get headaches. I do. It's
Stop thinking about it then.
and it's just like I was looking at and getting off topic, but I was looking at these condos because like I don't want to buy a house. What am I gonna do with like a house with a lawn to mow and then something happen? Like what am I gonna do with all that? I don't know. So I was looking at these condos and like the area that I live in now is the area that I would love to continue living in. The condos here, like for a nice condo, starts at like 1 million, right? And then the like so-so condos, they start at like five, right? But then when you look down, the HOA is like $1,000.
Yeah, that's the thing with condos. Yeah.
So, anyways, so that's my dilemma. So as I like perseverate on this, instead of keep and there is a breakdown. And I'll give you my little disclaimer. There is a breakdown. I do have some cash when it comes to saving for my like down payment, but the majority of the money that I would potentially use is in investments,
Hmm.
right? I have it sitting in a regular investment account, after tax investment account. I deposit it, I deposit maybe a couple of $100 every month, and it goes into another investment vehicle. So usually stocks or ETFs, and it makes me money. And now, lucky for me, I wasn't looking to buy a house, a year and a half ago when the stock markets went down, but that investment went down. I didn't sell because you don't sell. Um, it went way down. I think I went down from I think I lost almost 50%. Well, it went down about 50%, right? Or even more. But it's back now because I never sold. I wish I had money to buy. I didn't. Right. But so again, off topic. Basically, I don't know when I'm buying a house. So any money that I have sitting in a bank account making 1 or 2% is useless. I can put that money into an investment vehicle and then grow that money a little bit faster than if it was sitting in bank of who knows who.
Yeah, exactly. And I agree with that. Um, it's no different than keeping it under your mattress, to be quite honest with you. In
Yeah.
fact, when you calculate inflation, it's probably worse than keeping it under your mattress.
When you have banks kind of going out of business, it's probably safer to keep it under your mattress sometimes.
Yeah.
There was those where I don't know if you were paying attention, but there were those banks. I don't remember the names of them. Was it Regional Bank or something like that in California? And they were closing their doors. They had to be bailed out and all that stuff like that. Not long ago, just recently.
There was several actually, right?
Yeah, right. And like people's money was they were gonna lose their money. I don't know if anyone did because it was like above the amount that's insured.
Yeah, some big tech companies were keeping their money in some of those banks as
Hmm.
well, right?
Okay, so when you first get that money, right? So say you're starting, you've decided that you want to do something. I would say the first thing you want to do is think about what your timeline for that goal is, right? So I am planning a trip, say, and this is hypothetical. I am planning a trip to Japan. I want to go to Japan in 1 year, right? So I'm going to save that money because I need that money in a short period of time, and I definitely need that money. All right.
Hmm.
Um, I am saving for retirement. I am going to retire in 20 years. I will need that money, yes, but I have time to invest that money and hopefully grow it over that period of time.
Yeah. Time horizon. And in engineering, we call that reverse engineering, right? You begin with the end in mind, and then you just reverse engineer it to your current moment and close the gap. What's it going to take to close the gap?
I like that. Reverse engineer your money.
Yeah, very powerful.
Mhm.
So time. What else?
Well, we touched a base on it a little bit, but inflation, right?
Inflation.
So tell me a little bit, how does inflation play in the differences between savings and investing?
So where it comes into play, inflation. So let's use Canada, right? So in the current inflation for updated on March 19th, 2024, is 2.8. Now that's not the average, right? But that's the current in the moment, right? So usually they look at this the cost, the consumer price index, which gives an average. But let's look at the current 2.8. So if I put $100,000 in, let's say, a savings account or a checking account, and it's getting less than that 2.8%, I'm actually gaining zero. So if that checking account gave me 2.8%, my net gain is 0%, right? I'm actually, because I'm losing that 2.8% to inflation that they're giving me to inflation. So that's why when it comes to investing, you need to have some sort of upside or protection against that. So if you're investing, you have to be getting more than 2.8% when it comes to your rate of return, right? So you do some quick math. If you're getting 3.8% in your investment, as an example, you're really earning 1%, right? So when it comes to savings, yeah, you're okay when it comes to the inflation because it's usually a short-term need, let's say. But when it comes to investment, typically it's a longer time horizon, going back to your point, right? It's a longer time horizon. You want to protect against that. You want to protect against that somehow by earning more, by having a higher rate of return.
So basically, when you save, your over a long period of time, your money will be worth less than the time period in which you actually saved it, right?
Yes,
So the $1 that I save today is not going to be worth and yes, it's $1, but it's not going to be spent as the same $1. So where I can use $1 and buy one pen today, that one pen may cost $1.15 in a year.
you got it. And I was going to use the example I remember vividly. It was in somewhere in the year 2001. Me and mom was driving in that old. Do you remember that old black Volvo?
Hmm.
Okay. And she was going, there was a gas station on Steeles and Bramley. It's no
Emily.
longer there,
Hmm.
right? The Pioneer. And she was complaining that gas was 50 cents, right? She was upset. That was a high price at that time,
Oh my
50
gosh,
cents.
less
And
than $1.
so you take that dollar, you could get 2 liters of gas. Here in Canada, we use liters, I know. You
Like
can
the rest of the world.
you could get 2 liters of gas. But now you fast forward today, it's like, I don't know, $1.30 or something. So that $1, the same dollar, right? If you kept that dollar under your couch and you wanted to spend that same dollar today, back then you could get 2 liters. Today, you can't even get 1 liter, the same dollar, right? And that's why your time horizon is very important with the protection of inflation.
Absolutely. 100% agree. Uh,
So inflation protection, you mentioned. Now, talk to me about tax implications.
Taxes. I hate taxes.
You and me both.
I still have you done your taxes for the year?
Not yet.
Yeah.
Not yet.
It's April 1st tomorrow.
Yeah, that
What are
is.
they due? The 15th in the US, I think. I do my own taxes, so that's why it's annoying.
No,
Uh,
we're almost there.
huh? Oh, taxes?
Yeah, like for me, with the business, everything, getting all the expenses together and everything. April 30th is our deadline
Oh,
in Canada. So
yeah.
we still have 30 days.
I have 2 weeks. It's fine. So, tax implications. You know, when it comes to saving, you're you're going to pay tax on the first part of the money, right? So say you make $20 an hour, you work 5 hours, you get $100. You're going to pay whatever tax rate the tax man wants. Say it's 10%, right? I wish.
I was going to say, I wish too.
Amount of money that Biden takes out of my account. It's annoying. So say 10% because we're living in a dream world. So you have $90, right? And you have that $90 to save. They're not going to take any more money out of that $90, right?
Mhm.
Outside of when you go spend it,
Mhm.
right? So you have uh the money they take out when you earn it, and then they have the money you take out when you spend it. So that the savings, it was $90, $90, fine. Now for investing, you're going to take that same $90 and you're going to put it into whatever vehicle, right? Then you're going to earn, so say you earn back your 10%, right? So now you have $100. When you remove it from that vehicle, you get your $90. You don't owe any tax on the $90, but then you're going to owe tax on the $10, at least here in the States, right? And of course, it depends on how long you keep it in, how much you're going to actually end up paying on that gain. So that is something to keep in mind. Now, there are different vehicles, at least in the States and in Canada too, if I remember correctly, where you can lessen the amount that you're going to have to pay, or if you pay at all. But it is something to keep in mind that anything that you gain in your investment, you are also going to have to pay a certain amount of tax too. That's the first tax implication that I can think of. Is there anything else that you can think of, Jermaine?
No, I think you hit the nail on the head. I mean, basically, there are vehicles that you can use to lessen the taxes when you save and also when you invest. But if you're gonna put money, like sometimes people say, well, how will I pay save? Let's say I have a savings account. How will I pay taxes? Here in Canada, at least, if and the problem is you don't earn any money on the taxes. I mean, on the money, right? So if you had growth on your money, yeah, you would pay taxes in your savings account, all right? If you had a high enough interest rate, but it's nominal. That's why most people don't see it. Uh, but yeah, tax is one of those things that it's a silent thief. It takes your money.
I hate taxes. So let me tell you, there was one year, like it was during COVID, where
Hmm.
I had made like a decent amount in the stock market. And I was like, oh, sweet. All right, awesome. And then this is where I was saying about like the amount of time in which you have your money in the investment. These are all short-term investments. So I think I had to pay like 40% of my like on my gains, on my capital gains. I came out and my taxes came out to like $15,000 that year. So
Wow.
annoyed.
Wow.
$15,000. I mean, I guess yay, you made that, right? Whatever. But still, who wants to give the government additional $15,000 out of what they already take out of your paycheck?
Yeah, we had a situation once where the accountant that we were using that year, we had to pay a high tax bill, and their solution was to earn less money. We never used that accountant. We fired that accountant immediately.
With the quickness,
Yeah.
please.
So we talked about tax implications. What's next?
So same thing that we've kind of been talking about already is the potential for growth, right? With savings, your growth potential is going to be depending on what vehicle you're saving your money in, and will be capped at whatever percentage that is agreed upon. So if you have it in a savings account and it's 2%, you're going to gain 2%. You're not really going to gain anything more than that.
Hmm.
Uh, versus investing, dependent on what you put it in, but ultimately your growth is unlimited.
Yeah.
But also
And
so is your loss.
you know, you're right. I was thinking of an analogy as you said that investing to me is like you send your money out to create more baby monies and bring you back more monies, right? Visualization. So, whereas if you send your money
Go
out,
forth and multiply.
yeah, exactly, right? Go make more money and bring it back, right? And that's investing. That's investing. Hence why, and this is another topic when we're going to do our other show, probably next week, we'll talk about that.
Next week, we're talking about money management.
Money management. Yeah. So don't miss it. And you don't want to eat your money because then it can't create more babies, right? It loses that growth potential. It can't go work for you, right? Can't go work for you. So yeah, I agree. Growth potential, investing, not so much when it comes to savings, which leads us into our next part, diversification. How do we diversify for savings versus how do we diversify for investing? Do we need to diversify for savings, right? Must we diversify when it comes to investing? What's your take on that?
So savings, I wouldn't really say that there's like a whole lot of diversification, right? Well, you're keeping your money, you're keeping your money, right? That's like you can, and if you, depending on how liquid you need it,
Mm-hmm.
right? So I guess if you could say, if you wanted to diversify, you may keep it in something that may not grow, but may hold its value. So like gold, is that like one of them?
Yeah,
Right.
gold holds its value. That's correct.
Yeah. Right. So you want to like maybe if you want to keep the value of it, but you don't necessarily need it there, you may put it into certain vehicles like that. Um, but you're not necessarily getting a huge return on it, depending on how it does there, right? Um, and then for investment, there's very many ways, there's a lot of ways to diversify. I mean, you can, if you're putting your money in stocks, you can diversify in the types of companies that you are putting your money or investing your money in, right? You can diversify in the types of investment. So you can invest in the stock market, you can invest in um, businesses, you can invest in real estate. Help me out, Jermaine. What else do you got here?
Well, there's, like you said, business, real estate. You can invest in um, different. I don't like crypto. People invest in those things. Um,
I still have some crypto.
huh?
I still have some crypto. Not a lot. It's like 0.1% of my portfolio.
This is my point. This is my point.
Well,
It's
actually, it's not even 0.1, but I've started reinvesting in it. I think I'm putting like $50 a month.
things that pay you dividend, right?
Mhm.
There's various ways, right? Various ways that you can invest versus savings. Um, Anything that's going to give you a rate of return is how I would sum it up. Now, when it comes to investing, you can, and I would consider you to be an active investor. Um,
Me?
yeah,
Okay.
so you have, now that's the investing part, but what about management? Management of the money. There's active management and there's passive management. What are the differences? How would you define the differences to the audience?
So when you're looking at those terms in the setting of savings versus investing,
Yes.
savings, I would say there's very little management you have to do versus maybe outside of maybe choosing the vehicle in which you save your money in, right? Versus investing, you have to actively choose, right? You may not be picking stocks if you don't want to, but you're going to pick the people that are going to manage your profile. You're going to check you're going to check to make sure your money is still there, right? If you if you put your money in real estate, you're going to make sure the real estate is doing what it's supposed to do, right? So there's still you're not really going to set it and forget it per se.
Mhm.
Right? You're going to do something of some sort to make sure your money is doing what you set it out to do.
Either you or someone, because keep in mind too, you can hire someone to
Correct. But you have
manage
to
it
pick the
for you,
person.
right?
You have
Yeah,
to
but a
hire that person.
percentage has to go to that person. And many people here in Canada, for example, if you invest in any type of fund, okay, whether it's a mutual fund or segregated fund, there's something attached to it called a management expense ratio, an MER. And that is the percentage that you're paying for a money manager to go and manage your funds. So you might say, but Jermaine, Camille, I'm not managing anything. They're managing it. Yeah, but you pay, to Camille's point, you pay for someone to manage that fund for you.
Absolutely. And you want that to be as low as possible.
Yeah, exactly.
All right. What's next?
Financial
Financial
goals.
goals.
Yeah. Jinx.
Jinx.
You can tell we're brothers and sisters. So financial goals plays a big role, whether you save, whether you invest, right? So you have to determine what that outcome is. And you said it very nicely. What is that end that you're looking at? And you're going to invest or save depending on what the outcome is, right? Some is common sense, but I think some is a mixture. I think depending on the outcome, you might want to balance it and have a mixture there, right? So let's let's see. How do you respond to that? What's your take on that?
So, no, I agree. So you want to again start with the end in mind, right? And then, one thing that I came across is using that same old that we've heard it a million times, those SMART goals, right? So specific, measurable, attainable, relevant, and then time bound, right? So you can use that same system when you are setting forth with your financial goals to figure out what vehicles and what approach you should be taking towards your money, right? Because ultimately it's your money. Um, and use that to figure out whether you should be saving this and whether you should be investing it.
Mm-hmm. Yeah. And what's your approach? We were talking a little bit off camera earlier.
Mhm.
What's your personal perspective with what is that right balance? Like you have a certain state that you're in right now, right?
Mhm.
And based on your current state, you have an approach. What is that approach? How did you find that approach? And what is that approach?
So I'll be honest, I didn't really do anything specific. I was like, this is how much money I need to live. I don't have any like super big concerns about being um unable to make money, right? Like if I lose a job, I'll be able to get another job in like maybe 3 to 6 months time. So I set that aside that I need, right? So emergency, so
Mm-hmm.
that's there. And then outside of that, most of it is investing right now because I'm like slowly creeping into the okay, maybe I'll buy a house camp. There's a little bit more that's going into savings. But the majority, like 3 years ago, the majority of my money was going into investing. Uh,
Mm-hmm.
and I was perfectly fine. Like if I looked in my bank account and I had a couple extra $100, it's like boom, going into, savings account, investing account, boom, investing. Let me buy some more stocks. I was buying stocks like crazy. And it works for me because if I've never sold anything per se. Like I will do options and I've sold a couple of things, but anything that I've specifically invested in, I've like I have it. It's mine. I own that company. Um, but so yeah, so I am very like investment prone
Mm-hmm.
because I don't have a quick need for money at the moment. That may
Right.
change, but I know that I can do without that money and I can invest it. And if I sell it, I'm not gonna have a great issue, right? So I'm investment first, saving as needed, and then spend the rest.
Got it. Got it. My approach is 20% should go towards investing and saving, right? So a balance mix, somewhere maybe 50-50, 10 towards savings, 10 towards investing, uh, and then spend the rest, right? So whereas you use that word to set it and forget it. So that 20% is allocated, and you got to find a way to live on that 80%, right? Don't go outside of that 80%. And then you kind of set it, forget it, and it all starts with that outcome. What's that outcome? Because there's, in my state, there's children, right? There's retirement, there is emergency fund, there's all these different needs that are there, right? So you got to have something put aside for any of those needs, or when those needs arise, and they will come up at some point. So it's protecting against the downside, I'll call it, to make sure that savings is there and also investing is there.
Yeah. I mean, I didn't know we were giving percentages now, but so I guess if my rough percentages at this particular time is that I save 22%, and then I invest 15%. And like for savings, that's emergency fund and travel. Um, that's all I save for. Uh, I have no kids. I have no responsibility. And then investment is 15, and that's the very rough, because I invest for my 401k, so like pre-tax, and then I invest post-tax. And then I invest like post-tax as in like a Roth IRA. So equivalent in Canada would be your tax-free savings account. And then I invest in a taxable savings account as well,
Mm-hmm.
which roughly is maybe about 15%. And then the $50 I send to crypto every month.
So you're around it.
Around, very diversified. The
Yeah.
only thing I don't have is like a real estate investment. I
Yes.
tried, but then well, yeah, that's where we're going. But like I tried, let me not talk about that offline.
Yet. It's coming.
It's
It's coming.
coming.
By the way, I want to give a special thanks to the subscribers. Thank you for subscribing to our channel. We appreciate you. And we are going to bring you value every single week. We're going to give it our best. All right. Leave in comments any topics maybe that you'd like to see. You could leave it in the comments. We'd like to hear that. And we'd love to hear more from you. So thank you again. Special thank you to our subscribers. We're 13% on our goal. Our first milestone is 100 subscribers. So we're at 13 right now, growing.
Yes, and if you aren't subscribed and you're watching this video and you like what you see, please hit that subscribe button, hit that thumbs up button, leave a comment, and come back next week to see us talk about money management. And I promise I'll have my percentages right by then.
We'll be here next Sunday. Thank you for joining us.
Bye.